conference. My name is Susan Carroll, and it's my pleasure to be your MC for this two-day event. Our topic is a very timely one. 10 years after its conception, has the banking union stood the test of time? Well, we're going to find out over the next 2 days. But before we officially start, just a bit of information from me, particularly for those of you joining us online, and we had more than 600 people registered. Thank you very much for that. Just to tell you how you can interact with us. We will be taking questions via Mentimeter. You can see on your screens details of how to submit them. For our in-person audience, I think the traditional raising of the hand still works just fine. You can also follow the discussions online on Twitter using the hashtag SRB ECB 2022. Finally, a hint to all of our speakers, we are on the record. Our speeches and our discussions are being streamed live on the SRB and ECB websites and also on YouTube. Now let's get started. It's my pleasure to hand over to our joint host, Andrea Enria, Chair of the Supervisory Board of the European Central Bank, for some opening words. Mr. Enria.
Thank you very much. I'm really very glad to welcome you to our first conference, joint ECB and Single Resolution Board. We have been thinking about this for a while, and finally we managed to do it. And finally we managed to do it in person, at least in part, and also at the exact time of the 10 years anniversary of the conception of the banking union, which was proposed at the European Council at the end of June in 2012, so 10 years ago. However, the single supervisory mechanism was not legally in force until 2.5 years after that decision, and it was after 4 years that the Single Resolution Board was legally operational. So from the point of view of our age, the two institutions, the two pillars of the banking union have been operational for much less than a decade. But yet, I think that we can say that we have achieved quite a lot in this period. The considerable reduction in non-performing loans, the de-risking of the bank's balance sheet from 8% NPL ratio in 2014 when the ECB started its tasks to the end of last year, 2%. And also the supervisory response to the crisis, to the pandemic that was very, very fast and enabled banks to continue supporting corporates and households also in the first very difficult times of that crisis. And empirical evidence shows that space that we gave as supervisors was useful, was used by banks to continue supporting lending and the economy as a whole. Also the decision not to distribute dividend, to recommend not to distribute dividends, and to create operational relief for the banks, I think was very, very useful at that time. But what for me was really key was that for the first time there was a joined up response. So supervisory, monetary policy, fiscal response, regulations, everything moved in the same direction, showing that a symmetric shock was actually met with a comprehensive policy action at the European level for the first time. And also the SRB, of course, Elke will say much more than I can, but established itself as a strong pan-European resolution authority, and this was reflected not only in terms of banks' preparedness, so through resolution planning and a minimum requirement for own funds and eligible liabilities, but also swift interventions in the few cases, luckily, that we have, of banks that we had failing or likely to fail in these first years of the banking union. So this unified response would not have been possible if it was not with the banking union in place. Would have been unthinkable, really. And I want to stress that, and that's why this meeting for me is important, is that close cooperation between the SSM and the SRB has been integral part of our efforts throughout all these years. Take also our joint handling of recent crisis cases such as Bergen. I mean, given the limited time available to respond to fast-moving crisis situations and the relatively complex, let's say, decision-making processes that we have, it would be impossible, I would say, without effective cooperation to manage the orderly wind down of a bank. And this concerns not only the quick exchange of information at the time, but also the consultation and cooperation between the two authorities as provided by legislation throughout the whole process. And this collaboration is not only an issue of the last days of life of a bank. No, it's the end point of a coordination process that starts much earlier, as set out also in our interinstitutional memorandum of understanding. To make sure that both institutions are on the same page when push comes to shove, the ECB is consulted on the resolution plans that the SRB prepares, while the SRB provides feedback, of course, on the recovery plans of significant institutions that the ECB is responsible for. And our information exchange is not limited to crisis cases, but we are also sharing insights on key system-wide vulnerabilities. We, for instance, now work together in the extended contact group monitoring developments following the aggression of Russia in Ukraine. And we are exchanging always bank-specific informations, also on matters such as MREL. So we have come a long way. We have certainly not yet reached our final destination. The banking union remains incomplete in several respects. For large banks, we have a uniform and effective crisis management framework in place, but the same cannot be said for small and medium-sized banks. Prudential regulatory barriers to a truly single European banking market remain. In terms of what we call homemost, I hate referring to homemost for something that happens within the banking union, but still what we improperly call homemost issues within the banking union. And the third pillar of the banking union, of course, a common deposit insurance scheme, is still missing. All these issues were discussed at the Eurogroup meeting last week, but an agreement on a roadmap to complete the banking union proved elusive once again. These are complex political negotiations that go to the very heart of the kind of union we want as European citizens. And here I'm not talking only about the banking union, but also about the European Union itself. It is only natural that there are different viewpoints and that negotiations are proving complex. But as I've said time and again, I'm today more convinced than ever that we cannot stand still while complex political negotiations play out. This is why we have, my colleagues, the colleagues in the SRB, once and again explored avenues to maximize the full potential of the legal and regulatory framework that we currently have in place. This concerns in particular the prudential regulatory obstacles still impeding the cross-border integration of the EU banking sector. More recently, I raised also some proposal for incremental reforms of our crisis management framework, in particular for the resolution of mid-sized banks. We regularly discuss these issues with ELKE, with the colleagues at the SRB, and I believe we share a lot of views on a number of issues as a result of our common experience with crisis cases in the first years of the banking union. These reforms should, in my opinion, include an expansion of the pool of banks which qualify for resolution, an expanded role for DGS for deposit guarantee schemes, other than their paybox function, boosting the ability to fund on a least cost basis the smooth exit from the market, also smaller banks, a widespread use of the purchase and assumption transactions that along the years have proved to be the cornerstone of the US successful framework for crisis management and resolution, and therefore a harmonized framework for administrative liquidation. I mean, they're all very consistent and part of a package in my view. And again, even though I was disappointing, as everybody else here in this room, that there couldn't be broader agreement last week, I take comfort from the fact that the finance ministers agreed to improve the resolution framework, mostly along the lines that we discussed with our colleagues, and which seems to be important, improvements based on the experience that we had so far. I'm about to give the floor to Commissioner McGuinness to kick off the conference with her keynote speech, and would like to underscore that I personally look forward to cooperating with her, with Elke, with Sean, offering all the technical advice my staff can provide for a comprehensive review of the crisis management framework in order to make it more effective. At ECB Banking Supervision, we are acutely aware that an effective framework for market exit that does not imperil financial stability is key for an efficient banking sector, able also to compete on a global scale. And I'm reassured by the fact that at least this prong of the regulatory reform program has been mandated to the ordinary legislative procedure with initiative from the Commission and agreement between the co-legislators, because I believe in this way the entrenched political obstacles, the red lines that we have been hearing about in this period go in the second line, and we have the appropriate decision-making process to try to move ahead. I'm sure that these 2 days we will be hearing many analyses and proposals on how to improve our current regulatory framework, both for the SSM and the SRB. And again, I'm sure that the discussion will be extremely insightful and fruitful, even though the holy grail of the single deposit guarantee scheme will not be at the center stage of the table. And I'm very much looking forward to the discussion and the debate. So after Commissioner McGuinness' keynote speech, today's first panel, moderated by Laura Noonan, will discuss how to move crisis management forward, and I look forward to the insights from our panelists, Sean Berrigan, Elke Koenig, Peter Simon, and Irene Tinagli will offer to us. The following panel will have its eyes firmly on the future. Jennifer Baker will moderate a discussion with Patricia Boydens, David Martin Lopez, and Marilyn Picaro on how the banking sector might look like in 2040. Following tomorrow's keynote speech by Johan Thijs, a topic that has become even more salient due to the Russia's war in Ukraine, will take center stage: operational resilience. The ECB and banks alike actually have already been on a high alert for cyber risk, and Russia's waging war on Ukraine, with increasing risk of cyber attacks, has only heightened our and the bank's vigilance in this area. While so far cyber attacks were primarily financially motivated, there is now a threat that aims at the destruction of critical infrastructures, trying to cause as much disruption as possible. Elena Carletti, Elizabeth McCall, Christian Ossig, and Fernando Restoy will explore ways of safeguarding banks' operational resilience in these turbulent times in a discussion moderated by Raymond Franken. And Elke will tomorrow conclude the conference with her closing remarks. Before I conclude this short introduction, allow me to thank Elke for the very fruitful cooperation along these years, both when I was chairing the European Banking Authority and now as chair of the ECB Supervisory Board. I've already praised the level of cooperation and information sharing between our two institutions, but I would also like to thank Elke for our personal interaction and cooperation during this period. She has been an outstanding first chair of the Single Resolution Board, and I know from personal experience that it's not so easy to set up new institutions, and especially so if you need to tackle difficult challenges in the first years of your life. And as I mentioned, this is the first SRB and ECB conference, but also the last that we will host together. Elke will leave at the end of this year. I will leave at the end of next year. But we still have full 6 months to collaborate closely, hopefully not on concrete crisis cases. And the close collaboration between the SRB and the ECB, I think, is a strength of our institutional framework. And this has been built also through institutions are made also of people, and the good relationship between the leadership of the two institutions, which has been built up by Daniel Nui, by Elke, partly by myself, is something that I think we need to treasure and preserve in the years to come. So thank you very much for your attention. Thank you.
Many thanks, Mr. Enria, for introducing our conference so well. As you reminded us, the banking union, while not complete, certainly has plenty of room to develop. And in this light, we have a keynote speech from the ideal person to set the scene for our discussions today. And she's kindly agreed to take a couple of questions afterwards, so please submit them now. Please welcome Mairead McGuinness, Commissioner for Financial Services, Financial Stability and Capital Markets Union.
Thank you. So, very good afternoon, everyone. I'm not sure if you saw a photograph been taken over there of 4 people with a sign over them, the test of time. I'm a little worried about where that photograph will end up with that heading on it. But can I say the actual theme of this conference is really important because we are marking 10 years, but we're not resting on our laurels because we have a lot of work to do. And to some extent, if you hear things twice, Andrea, you have said much of what I want to endorse, but I think that's no harm, because we need to be very clear and very straight about the path ahead and about the need to go on this journey, even if there are little difficulties and twists and turns. So very happy to be here because this is a topic that's hugely important for the European Union. And as you know, it's often in times of crisis that the European Union does its best. It deals with crisis because we absolutely have to, and we can take very difficult decisions that would not happen, let's say, in normal times. And we can be very ambitious. And look what happened during the COVID crisis. And I suppose the banking union, like many of these big European projects, is one of an ongoing story of maybe small steps, some big leaps. It's a collection of initiatives launched in the aftermath of the global crisis and to ensure greater financial stability and to strengthen our single currency through deeper integration of the euro area banking system. If we look back to a decade ago, the global financial crisis and then the euro area debt crisis raised fundamental questions on the very future of our banking system. To contribute to financial stability in the eurozone, it became very clear we needed a strong and safe banking system, working easily across national borders with less ties to individual countries. So over that past decade, we embarked together on the journey towards our ultimate destination of banking union. We considerably changed our banking sector and shaped a whole new regulatory and supervisory architecture for our banking system. But we're still on that journey, and we're not there yet. We have not reached our final destination. But it's important to mark the fact that we have made significant progress already. So the first and second pillars of the banking union are up and running. The SSM brings clear benefits in terms of the level playing field. It gives confidence that banks are supervised in a consistent manner across the banking union. And there have been continuous progress on crisis preparedness, improving the resolvability of banks and building up capital buffers. Our capacity to handle the failure of European banks without affecting financial stability has improved markedly. And a common backstop to the Single Resolution Fund will soon enter into force, boosting confidence in the bank resolution framework. We've also put in place a single rule book for banks across the single market. And at its very core are stronger capital and liquidity requirements for banks, improved depositor protection rules, and rules to manage the recovery or resolution of a failing bank. And indeed, the recent case of the Court of Justice in the Banco Popular case confirms the robustness of our harmonised resolution framework and the strengthening of the powers of the SRB. And we see results. We see good results. Our banks proved resilient during the pandemic. Andrea, you referred to that. They continued to provide liquidity and services despite lockdowns, and this helped to deliver many government measures to support the economy. Of course, the consequences of the Russian invasion of Ukraine at this point in our financial system, we are vigilant, but they are under control. Because our collective efforts thus far has helped to make our banking sector stronger and safer. And now to the core of today's conference, the test of time, banking union 10 years on. Will our framework pass the test? And I think we all know that there are new risks and challenges emerging, not least geopolitical tensions, macroeconomic risks, the climate crisis, and the digital transition. Now, these developments, some bring opportunities. The banking sector will have an important role to play in mobilising the investment needed for this twin climate and digital transitions and the shift towards more diversified energy sources. And this is an absolutely urgent topic. But the uncertain economic and geopolitical environment also carries risks that could test the resilience of our banking system. We know inflation is now a reality. Interest rates are expected to increase. And while the COVID crisis is no longer headline news, it has not gone away. Our banking system would be further strengthened to deal with these challenges if it could operate on an integrated EU market, backed by an institutional setup that provides adequate safety nets. So despite the impressive progress over the last 10 years, there is a lot of work which we need to do, and we need to do it together, because we're still missing an important piece of the framework. A decade on, the third pillar of banking union, a European deposit insurance scheme, is still missing. EDIS would increase the resilience in the overall system by pooling some funds at banking union level. A political agreement to establish EDIS would require progress on other outstanding elements of the banking union. A comprehensive work plan for the finalisation of banking union didn't emerge from the Eurogroup. We were hoping it would. I think everyone in this room was hoping that it would. But the determined efforts of the Eurogroup President, Pascal Donoghue, ensured that the Eurogroup took a pragmatic step forward, focusing on improving the existing crisis management and deposit insurance framework. I always see the glass as half full. And we will use here in the Commission that pragmatic step forward to address improvements in crisis management, because we know the framework would benefit from that. We will work on a legislative proposal to reform crisis management and deposit insurance. And this reform would aim to improve our capacity to manage bank failures while maintaining financial stability, protecting depositors and safeguarding taxpayers' money. Our goal should be to ensure that any bank can exit the market smoothly. However, we do not underestimate the challenges we will face to reach agreement on the reform. I've said repeatedly, there is a lot of heavy lifting to be done, and we will only succeed with a clear commitment from our co-legislators to engage constructively in those negotiations and show the necessary willingness to compromise. As I'm learning, the Commission is well used to taking up difficult challenges, from the response to the pandemic, to the immediate response to the Russian invasion of Ukraine. And we will continue to play our part in driving banking union forward. Our collective destination remains a complete banking union, and if that's the one message I want to get across, that is the message coming strongly from us in the Commission. It may not be fully in view today, but I believe we will get there because we have a signpost in the right direction. So I hope this conference allows us to have these deep discussions about what is necessary. I gather I'm going to be quizzed now, but I want to thank you for your attention and indeed for the opportunity to be with you. Do I stay or do I go?
You stay.
It's a line in a song, if I recall.
We can have a duet. Thank you very much, Commissioner, for your speech. We have a few questions coming on online, and then we'll turn to the room. So the first question is, and this is not coming from Elka, I believe. Are you pleased with the work of the SRB to date?
Yes.
And do you see any role for the SRB beyond resolution in the future?
Well, let's see what comes of our discussions. I mean, I think things evolve. So I don't think you should set everything in stone and say this is fixed. I would join in the kind remarks to Elka. Elka has been so determined that we would make progress, and you've made huge progress. So in these days where there is so much change in our financial system, collectively, then I think even in our regulation, we should not say this is done and it will not need to be looked at. So I would rather say that we need to be open to what might be necessary.
Great. And that, I think, brings us on neatly to the next question. If there are any clear milestones for the completion of the banking union, or what's next for the banking union? As Mr. Enria mentioned, there's plenty of room for development in the existing framework.
Look, I think we all know the steps. And we're going to take the one step that we've been tasked, if you like, by the Council, and that's on crisis management. And when I said this was, a pragmatic step forward, that's important because it gave us a signal that while it was difficult to go much further, those in the room realise we have to go much further. And it's a question of time. So I won't say dates or times, but we know the elements of a complete banking union. And what it will need, I think, is a collective understanding that everybody will have to give a little, and that we will gain a lot from that. So that's my conviction. It's better not to give dates unless you're absolutely certain.
Indeed, thank you. Is there anybody in the room here in Brussels who would like to ask a question of the Commissioner? If not, I have more online.
I thought I was free.
One last question, Commissioner. I know you don't have much time. Despite your commitment, unfortunately, the banking union remains incomplete. But could you explain why it is blocked in your opinion? Do you think it's because the bail-in rules, for example, aren't fully respected in the Eurozone member states?
I think it's much more, in a way, basic than that to some extent. We did what we had to do in a crisis, and we just didn't finish it. And I think now, in a sense, if you look at our banking sector, is more nationalised, than it was indeed even in the past. So I think it's about political willingness to understand why a colleague across the room has an issue, and that if you give, they can. And I think there was a sense in the room, actually, last week that we could do that. But I have to respect the fact that those who were present just couldn't take that huge leap forward. But I think the president of the Eurogroup, and I indeed maybe from Council this week, the European Council, will keep this very much in the radar, because there's great opportunities from completing banking union, and why would we delay? Thank you.
Thank you very much, Commissioner. Please join me in thanking. Thank you for your time and your questions. Thank you very much. And now let's take a deeper dive into the outlook for crisis management and the resolution framework with our next panel today, which is moderated by Laura Noonan, Financial Regulation Editor of the Financial Times. And Laura will introduce her panel. Over to you, Laura.
Thank you very much, Susan. I'm delighted to be the third Irish person that you guys have out of the three speakers so far. And I've got a fourth Irish person to my right here, Sean Berrigan, who, as most of you know, is, what's your full title? I know it's got a lot of words. Sean, maybe you'd like to share your full title.
Director General for Financial Stability, Financial Services and Capital Markets Union.
Excellent. That's Sean.
FISMA will do, okay.
Well, I did have a ban on all acronyms for this panel. So
stick with this one. Huh?
All right. And then next to Sean, we have Elke Koenig, who is, do we call you director or chairperson or chair of the Single Resolution?
Whatever you want it.
Whatever we like it. Then we have Peter Simone, and you're currently representing the Association of, I'm the
managing director of the world's oldest global banking network, the World Savings and Retail Banking Institute, 98 years old, and the European arm, the European Savings and Retail Banking Group.
Thank you so much. And then next to Peter, we have Irena Tingali, who's chair of the EU's Committee on Economic and Monetary Affairs from the European Parliament. So I'm very delighted to have all of you guys here. As everyone in the room and in the audience knows, this isn't quite the conference that I think some of you expected to be a week ago, when it was meant to be something quite celebratory. And now I guess it's more a point for reflection as to where we are, where we go from here. Sean, I'll start with you. I mean, you've been here from the very, very, very start of this. We're now more than 10 years into the Banking Union project. We had a very good overview from the Commissioner earlier about the things that have been achieved, but did you expect to be further along by now, by 2022? Did you think we'd be done?
It's a difficult question to answer. I think possibly at the beginning, yes. But as time has gone on, I have become a little bit more, let's say, realistic about the pace of progress. I mean, I think there are two ways you can measure progress in a project like Banking Union, and this sounds a little bit kind of trite, but you can measure progress by how far you've come from the start, or you can measure progress by how long you still have to go to get to the end. Now, I think if we're fair, we've come a lot longer along the way, so we're more than halfway. I think the very fact we're sitting here in this conference with Andrea and the SSM, having organised it, Elke here for the SRB, shows that we have made a lot of progress. We have a single rule book, which we continually seek to improve, but it's largely there. And I'll come back to the improvement in a minute. But when I used to, 10 years ago, bore everybody about the benefits of banking union back then, and I can bore you again about them now if you want, we always had these three pillars, you remember? And the three pillars holding up the banking union, and two of them are the SSM and the SRM, and the third pillar was EDIS. So I think the story is that, I'm not disappointed that we're not further along. Of course, I would always like to be further along, but I'm realistic. But I do think, unless we get the third pillar in place, the banking union, although it works well, will not work optimally. And that's why it's important that we continue to push to have the third pillar in place.
And is there any argument that the third pillar is just, no offence, but like never going to happen, and we should just make the best of the two pillars we have and make those as optimised as we can get them? Because the third pillar, some of the differences are so entrenched that you could just be throwing good money after bad, spending more time on it. I can see Elke shaking your head, so I'll bring you in next.
No, I don't think so. I mean, I think you never want something that functions so suboptimally. So this is working well, but it could work better. And I don't think it's true, in fact, that we can never get to the point where deposit guarantee schemes at European level become sensible and become acceptable. We're not there yet, but I feel that if we continue to make the arguments, we will get there. And I think even what we're going to do now in terms of crisis management, I can give you a sneak preview, is going to very quickly reveal how even the improvements we will make in crisis management will not be the full amount, because the system could be even more robust if we had a third pillar. So the arguments for the third pillar aren't going to go away. I mean, there are obstacles that need to be removed, and they're difficult to remove, but the arguments why you need a third pillar will remain.
I'm going to bring you on this point as well, but first of all, a quick show of hands from the audience. How many of you think we will get a European deposit insurance scheme? Raise your hands. Okay, we have, for anyone who is not able to see the audience, we have a very healthy, I'd say 80%, although I'm not a math.
It's a good majority.
The good majority of the room thinks they'll get it. I should also say, sorry, those of you who are online, there is an online forum where you can ask questions. I think someone was going to give me an iPad so I could see those questions. So yeah, I'll get them from the iPad. Anyone in the room, just if at any point you want to ask a question, just raise your hand and we'll get a mic to you. Elke, your defence of the need for the third pillar.
I think we need a third pillar if, for the simple reason of the word that Andrea hates, that I hate, home host. Because so far we have a system where you have a European supervision, you have a European resolution scheme, but when it comes to deposit insurance, you are back to nationalizing. I could actually make a very simple argument, and I sometimes believe economics count. We have in Europe now, or we are building up the Single Resolution Fund, 1% of covered deposits. We are building up, or we have built up, the DGSs, 0.8% of deposits. Quite a healthy number, 1.8% in total. This is nicely comparing to the US. It's 2% of deposits in the US. But our system has one European pot and 21 plus national pots.
Yes.
So, and this is an argument where you could say it would be by far more efficient, and it would also protect the member states far better if it were a European system. The European part is fully now mutualized. The rest is fragmented. This is one argument, and I would also agree with Sean. I think we had been, and I would have hoped for more progress, like always, but we have been fairly close to moving the first step into EDIS. It was just one step too much, though. That's why when you now work on CMDI, you will get back to the same topics on harmonizing as a pre-step for then hopefully mutualizing it. I'm optimist by nature, otherwise I would never have taken up this job.
So do you think we'll see a deposit insurance guarantee scheme or the EDIS within your term? Do you think we'll see agreement on it?
My term ends in less than 6 months. Yes. By now, no. You won't see EDIS during these 6 months. I'm not even sure that you will see it
during Andrea's term?
During the term of my successor, but we will see it at some point.
During
a
our lifetime,
European version of FDIC. Well, I hope to live long, so I hope to see it.
Thank you very much, Elke. Peter, I'm going to bring you in here. How important is EDIS to your member banks?
We are so diverse as the European discussion is. We have members who are fully in favor of a fully fledged system, and we have members who are completely against it. And the discussions that we have here show that within Europe, there is not this bright consensus about this topic as here in the panel and in the room here. The problem, from my point of view, is that EDIS had a very, very bad start. I will never forget the day when the 5 Presidents paper came up. I read this passage, and you were asked...
Did you write this passage?
I read this passage, and I wondered how something like this could happen. Because here was suddenly on the table a final solution presented as the only possible and acceptable. And being in politics for many years, as the 5 presidents too, I asked myself, do you really start a political discussion like this? I think what we can all agree on is that we have to have the highest trust of depositors that we can reach. Looking what is necessary for this, I just want you all to remember that the mentioned 0.8 for the DGS, 1.8 together with the BRRD, is less, much less than the Commission in her first proposal for the DGS has proposed only for the DGS. Just to remember, 2.5, that was the starting point when the Commission told us all to reach trust within our countries, in the population of Europe, at the markets. We need to have not less than 2.5. 0.8 we ended up, 0.5 in France because of a concentrated banking market. So, but we have more trust than before, even if it's just 1/3 only for EDIS. So what this showed is to us, often it's not about only pure figures and only about pure systems. It's only about, do the people trust in something or not? And we all know that if it comes to the hardest case, no deposit guarantee system in this world will hold. Not the US system, not ours. But as long as people trust that everything is done, that they are in person protected, nothing happens. You get no bank runs. People keep calm. So we should, if we really want to bring a process forward that takes into account our all key interest to protect the depositor best, is that we should go all back to zero and think what is necessary to gain trust. And what do we urgently have to avoid to lose trust in systems where we have a lot of trust. In our membership, we have members who think it is very important for many reasons, for the home host problematic, for the trust in their countries, that we come to a fully fledged systems. But we have also members who say, in my country, in IPS systems, for example, are more deposits than in the first 20 European states deposit accumulated. If you damage trust in our system, just a little bit like this, what do you win for the stability of the overall system? So both arguments have a legitimate backgrounds. These are both legitimate positions. If we want to go ahead in Europe, we should get out of this front lines where we are in now since years, because then we will never end up good.
Okay.
When I say we should restart, last half of the sentence, I really mean we should go back to something that the former Chancellor Bismarck said in the 19th century already. He said, if you want to understand foreign policy, and it's exactly the same situation here, you have to put yourself in the shoes of the one who is standing in front of us and look at yourself and try to understand you. Then you understand him, and then you get together forward. I think acting like this is the only possibility to get ahead.
So there's lots there to pick up on, and I can see Elka and Sean are nodding at various points that they want to come in on. First of all, I want to bring in you, Irena. From your perspective, how difficult or how easy is it going to be, do you think, to get agreement on what EDIS will look like?
Well, we've seen how it's not easy, definitely. So I think we all wish to be here celebrating something, and actually...
Possibly not all of us.
Well, maybe, but I think most of the people that have been working in the European institutions trying to, achieve the advancement of the banking union are a little bit disappointed. I was disappointed when I read the conclusion of the Eurogroup, although I appreciated the effort that Pascal Donohoe put into this, and I really appreciated what he did. But I was, of course, disappointed by the outcome, where basically they agreed that they disagree on this, and they only agree on the fact they will just kick the can along the road, the endless road of the banking union. So I don't know. I've been wondering myself how we could change the framework and how we can achieve the result, because most of the people still, agree on the fact that we need to advance in the banking union, but apparently there is something about the journey that we've designed, or maybe the way it's been framed or proposed, or the way we've negotiated. And actually, if we look at it, it has been changing along the line. I mean, for example, at the very beginning, we'd always talk about the three pillars, but at the very beginning, there was supposed to be a fourth pillar of the banking union with the bank structural reform. That is another piece that fell along the road during the last 8 years. And that was supposed to be a reform of the banking system that aimed at, at the time there was the issue of the too big to fail, and this was seen as an important move to reduce the risk. And then this was abandoned eventually. Of course, Parliament has its own responsibility in that. I was not in the Parliament at the time, but I know that Parliament has a big responsibility on that. But my colleagues who were there at the time, they told me they didn't get any big signs of sorrow on the side of the Commission, which withdrew the proposal right after. I might be wrong, so I'm happy to engage. So we started to think in terms of, how can we achieve the banking union and still reducing the risk. We started to look at NPLs, for example. So we had the roadmap on the NPLs, the calendar provisioning. So we started to move a little bit the target, and then we started to discuss about the sovereign risk. So we started to move a little bit the target. And then the funny thing is that what they, we also changed the narrative. At the beginning, for example, the banking union, the possibility of having really cross-border big groups and exchanges was the mean to break, for example, the sovereign bank link, and then it became the opposite. The sovereign became the mean through which achieving the banking union. So we completely changed the approach. And I think we have to think about that, because probably the way that we framed things that made the road narrower and more rigid rather than trying to open up. So we started to eliminate instruments, to change the narrative, to change the final objective with the means through which achieving the objective. So I think this also ended up narrowing down the room for maneuver and for negotiation. So maybe now it's time to restart and trying to reopen the field and open up a little bit the possibilities, and maybe be more creative about how we want to set up the roadmap to achieve what I think everybody agrees is something that we badly need.
So are you talking about a more, in terms of like the design of what EDIS might look like, a more flexible approach to what it might look like, maybe a little bit different in different countries? Or
no, I'm thinking about the whole thing of banking union, because I agree on the fact that it's not that easy to tackle these things separately and trying to say, okay, first we do this, and then we do that, and then we can do this stepwise approach. It proved to be very, very difficult, especially when what was supposed to be the final outcome becomes a prerequisite step to get to the next step. So we are mixing up a little bit objectives with instruments, and people may feel that of course, as usually happens in negotiations, someone is more interested in step one but not in step two, and vice versa. Someone is not interested in step one but is interested in step two, but it says, okay, who grants me that if I agree on the step one, then the step two will arrive? Because you know what? Sometimes what happens is that I make a sacrifice on what is my, ideas, and I agree on step one, thinking that we will get to step two, and then step two never arrives. So I think that we need to be a little bit more holistic in the approach of the banking union, and trying to find a way to keep things together and find a new way of negotiating. But I don't have the right answer. Yeah. Otherwise, I would be in a different position maybe if I had all the answers to how to handle that. But my sense is that it's really trying to be a little bit more creative in how we approach it.
So Sean, from your perspective at this stage in the game, 10 years on, how easy is it to reimagine some parts of banking union in a more holistic way and to do what Irina's talking about?
Quite. I mean, if I'm honest, because I agree with Irina fully, but in a way, the process we've just come out of is exactly that process, where we tried to identify all the remaining steps in the banking union, tried to approach it in a holistic way, but it hasn't worked. That was the work plan, essentially, was to lay out all the various elements we wanted to put in place and then move in parallel. That hasn't really worked out. It was a heroic effort by the president of the Eurogroup, but it simply wasn't possible to overcome the many obstacles. So I think, in fact, now where we step is we are going to make a step forward in one of those pillars, which is crisis management. But what we will discover is that everything in banking union is a bit connected to everything else. So when you make this step forward, you're going to find that elements are not there that you would like to have there. And I think EDIS is one of those elements we will find that would be very useful to have if you're trying to build a fully consistent crisis management framework. But I wanted to come back to some of the comments on EDIS and the passages in the Five Presidents report, which I can't remember. It's 10 years ago. Maybe I did write them, maybe I didn't. I can't remember. But what we put on the table as a proposal in 2015 was, in fact, something which was all that came later. It was a complete move from liquidity to full risk sharing. It was, however, a consistent step. You just went from A to Z. There were no breaks in the middle. What happened in the discussion, of course, that people said they quite liked the step from A to M, but didn't want to go any further, and others wanted to go a bit further. So that all became another discussion about liquidity versus risk sharing, etc. But the first proposal we put on the table was internally consistent and had all three moving from, as you remember, liquidity to co-insurance to ultimately full risk sharing. So there's another effort which didn't work. But I think when we put it on the table, the idea was not to undermine confidence in national deposit schemes. It was quite the contrary. It was to reinforce confidence in national deposit schemes. Because I am one of those people who believes that if you have a single jurisdiction like banking union, then one of the characteristics of a single jurisdiction is single or uniform protection for depositors. So every depositor should feel as protected as every other depositor, irrespective of whether they're in one part of the union or another part of the union. And that's what EDIS was about. It was about levelling off and making sure that everybody ultimately has the same level of protection. I think the problem that arose was, of course, that there was a sense that the risks within the union were not randomly distributed, let's say, and that some parts of the system bore more risk of accessing EDIS than others. And there was a sense that some parts of the union would be subsidizing other parts of the union if they joined in a kind of mutualized framework. So we had the risk reduction, risk sharing debate, i.e. we needed to reduce all the risks in those parts of the union which were perceived as being more riskier so that we could then share risks. That actually was delivered. The risks have been reduced. They were identified in two respects: bail-inable liabilities available in banks and non-performing loans. And on both of these metrics, the risks have been pretty much removed. So that risk reduction, risk sharing story is over. I suppose that was why some of us were a bit optimistic about the EDIS discussion, because the risk reduction, the risk sharing debate had ended. But it wasn't to be. I mean, there are still other issues around that. But as I said, I still believe that as we go forward and work on crisis management, this one step, we're going to find that issues in the other pillars will re-emerge. So EDIS will be missed from the framework. Home host issues will most likely re-emerge in this context as well. So we will. I was never fully convinced of the kind of holistic approach in the sense of moving together at the same pace on all elements. It's very difficult to do that kind of general equilibrium stuff. But I do believe that even when you move sequentially, you will reach points where you have to stop and let the other parts catch up. So I think, what has come out of the Eurogroup is still a very good result. Crisis management is a very noble area to be working in, if I may be honest. It's a very important area to work in.
As we know well.
But we will discover that other parts of banking union will be needed.
Thank you. So I certainly do want to spend a fair chunk of this on crisis management, but we do have quite a few questions around EDIS. Elka, one for you from the audience, who says, is there not scope to use the billions and billions stored in the SRF to become part of the Europe-wide DGS? What do you do with the SRF as it sits idle waiting for a crisis?
Well, I'm not sure whether I'm so unhappy that it sits idle waiting for the moment, because it means that we didn't have a crisis where we had to even chip in this. And like the Commissioner said in the beginning, I think we've proven that we can resolve banks, but I'm not sure that our target should be, can we resolve 5 per year? It should always be the exception and not the rule to resolve banks. But
and what
pretty
do you do
clear.
With the money?
No, for the time being, it's very safely.
Is it in German
and I'm
bonds or
looking at
Italian?
our vice chair, who is responsible for managing the fund. It's not a pleasure to be an investor for very safe investments in this environment. We have made the point currently or recently to say, if you really want to take a first step into a liquidity facility, EDIS, which was the first step of EDIS, why not engage the fund in this? The fund could be the one to lend to this system. Well then, if nothing is happening, the money might still sit idle, but it then sits idle in a EDIS compartment, and to make it as a first step in the system. I still think it's worth thinking. It would need a lot of legal changes, probably.
Because I just also wonder, could the fund be the one to help narrow the yields on certain European countries' government debt?
I see that as a real challenge, and probably I could easily say this is not within the mandate of the SRF, and this is not in the mandate of the SRB and in the mandate of the fund. No, but I would still believe that moving from where we are with these scattered funds to moving to quality European FDIC model, and to be fair, we have moved a long way. Even 5 years ago, I would only have talked about a European FDIC if I were closer to the door than all the others, because I would have immediately been killed. Nowadays, I think half our constituency is probably saying, yes, this is where we want to end in some form or shape. For this, the money within the Single Resolution Fund could be one of the starting points to get the DGS component, to get an EDIS component working. It's a long way, and let's not be naive. We are regulated by a law or a regulation, but we also have an intergovernmental agreement and the like. So to get all this up and running will need political will need more steps to take. But let me perhaps, even as I have the chance, build on what Sean said. I think this idea, and it was an incredible effort and huge will put in by Pascal Donahoe to come up with all the bits and pieces will prove helpful because it shows that this all needs to be addressed, and the communication didn't say it will never ever come. It just says we start with one step and the next to come. And I'm firmly believing this is the only way you go forward, because if you say I need to address everything at the same time and a bit in tandem, for me normally translates at the end in it will be difficult and it might take long.
Okay, thank you very much. I'm going to come, one questioner has a more general point, which actually touched on something, Sean, we talked about earlier, which is Europe seems to make the biggest progress during and right after crises. Will it need another crisis for EDIS to happen? Peter, I'll go to you first on that one because you caught my eye.
It's not something that is a special rule for the financial sector. I think Europe, if you look in many political fields, often moved forward when there is a crisis, but it will be a crying shame if it only can move if there is a crisis. No, I think especially in the times where that are not so tough, we should all try to our very best to understand each other, because that's what it's all about in Europe, that one understands the others and its needs and his legitimate interests, and from this starting point trying to find solutions that are more pragmatical and less, let's say, ideological, as some of the positions had been here in the past, represented from all sides. I hope we move forward even if there's no further crisis in the next term.
Sean, was it easier to get things done in the good old days after the crisis?
Well, they weren't very good old days to start with. I mean, I have to say, it is true that we tend to make the bigger steps after crisis because, as the Commissioner said, there's something that has to be done, and then we get round the table and do it. Personally, and I speak personally, I've never found it a very efficient way to make progress, because you have to receive quite a bit of damage before you make progress. Far better to make the progress before. So, you know, it's a little bit like closing the door after the horse has bolted. Huh? So, and the banking union is a good example. I mean, we want the banking union because we want to restore the level of banking integration we had before the crisis. So now we have the architecture we need. The architecture we could have done with, by the way, to manage the integrated banking system before the crisis. We might not have had the crisis, frankly, if we'd had the banking union architecture before the crisis. But then we had the crisis, and then we get the architecture, and now we have to sort of use that to restore the damage that has been done. So, of course, from an institutional point of view, from a bureaucratic point of view, it's very good to say that we need a crisis and then we jump forward. But I think from an economist point of view, not the most efficient way to make progress on an institutional basis. And we should be able to, in periods of calm, work it out and move forward.
Elke, do you think we need a good crisis to get this going?
I would full-heartedly embark to Sean's argument. Of course, you fix your roof normally in good times, and when you see that we are in very uncharted water for the moment, I would rather like to have the roof fully fixed than just having a bit of plastic on and hope it will be sufficient. But honestly, I'm not so pessimistic. We have now, or the Commission now, has to come up, and I know there's a lot of work already gone into this with this crisis management, deposit insurance review. And don't forget, there's also the banking communication review, so the state aid framework. And this will get us fairly soon back to some of the more integral question on broadening the scope of banks that go into resolution. If you broaden the scope of banks going into resolution, then you need to know how you fund if need be. And there the paper of the Council is very clear. It says it's MREL on the one hand, so banks' own fund to be built up. And it is industry-funded tools. And for me, industry-funded tools first and foremost translates into DGSs. And this means you need to talk about exiting the banks. You need to harmonize the use of DGS, not just as a pay box, which might be not the most efficient way. So purchase and assumption transaction or sale of portfolios and banks. And for this, you need to harmonize the question on what could be the upper limit to use those funds. So there is a lot of steps which basically pave the way into EDIS.
Okay. I know we've taken a lot of questions, well, a few questions from the virtual audience. Have we any questions from the actual audience on the deposit guarantee scheme? Because we are going to move on to crisis management soonish. So if you have a question now on the deposit guarantee scheme, this would be a good time. Okay, the actual audience is very shy. So I'll come back to you. Got two more from the virtual audience, and while the actual audience try to gather some courage for the next time I ask you. From the virtual audience, are uninsured depositors of consumers, are uninsured depositors, i.e. consumers and SMEs, at risk with the current crisis management framework if they have deposited amounts at medium-sized banks? Elka, I guess. I know we talked
an easier question.
Bit about.
No, I would say the simple answer is no. We have a deposit insurance system, but the probably also honest answer is covered depositors are always safe. If the DGS is not sufficient, the national budget is the one to back the DGS. There is a clear understanding of a number of, whether you talk about SMEs, whether you talk about non-covered depositors, that you need to protect them in the interest of financial stability. And now let's be realistic. In most cases, this should be possible. Will it be a walk in the park? No. Will it, in some cases, overstretch the capabilities of the DGS? Yes. I am more fearful that it might overstretch, in some cases, the belief of depositors in other banks that the member state will manage. And this is, I think, again, a plea for a more European system, because we have seen it in the past. Well, if you see some trouble here, why should someone in another bank be so worried? Yes, but they are, because they believe the system might not be capable. And I think there, a European system is always a better basis.
Okay, thank you. Another one, Elka, which is probably going to be for you again, although Sean, you might want to chime in. Without an EDIS, is liability and control truly aligned within the banking union? So without having a European deposit insurance scheme, is liability and control truly aligned within the banking union? I can think of a one-word answer, but... I mean, no, surely.
Not truly aligned.
No.
But I mean, is it misaligned to the point where it's a fundamental sort of problem in the system? No. I mean, what we have done with banking union is we have produced a framework in which we can make decisions collectively as a union. So Andrea makes collective decisions through the SSM. For supervisor, single decisions. I don't even use collective, single decisions. And Elka will make single decisions for resolution. So these are the decisions that are taken. Now, what is often argued is, of course, that the implications of those decisions are sometimes left at national level. And there you can envisage some misalignment and incentives between decisions that are taken centrally and some of the costs that might be borne nationally. Those misalignments can be managed now, and they are managed now, but they would be, as I keep saying, it's not that banking union is not working. Banking union works. It would just work more efficiently and more effectively with the third pillar. So those collective decisions can be managed, and they are managed, but they could be managed more easily, more efficiently, if we had a third pillar. So this is the sort of my commissioner's line of the glass being half full. It is more than half full. I think it is 2/3 full. But, we prefer to have it full.
Full. Okay. Another question actually, Sean, which is, well, it's addressed to the Commission, which I guess in this case is you. In the case of Sberbank, this is an easy one actually. Well, the first part is, in the case of Sberbank, did the Austrian DGS have to pay out for the German branches of Sberbank? If the Austrian DGS had been too small, would the Austrian DGS be too small? Had the German operation been slightly larger? Which is more probably an Elka question.
They're both for Elka, I think.
Well, I think the answer is
very gallant of you, Sean.
Okay. I think the answer is...
Separation of responsibility,
Not sure. It's unfair. No, to be fair, the system is pretty clear that the Austrian Sberbank, or that Germany was a branch of Austrian Sberbank, and therefore the Austrian DGS was responsible for this, and from what I understood, was supported in administration by the German DGS to manage it. So the cost in this case are for the Austrian system, but also, to be fair, in this case, and the Austrian DGS has long been repaid
So can you
out of
talk
the
us through
proceeds.
how the overall case of the Austrian Sberbank worked, and if that was a good case of like resolution working well, do you think?
I think it was a very peculiar case. For me, a very good case and a very standard case of the resolution framework was the far larger case, Banco Popular, which was a bank that failed, which was also a cross-border active bank because it had a Portuguese subsidiary, and where the sale of business worked smoothly. If you were today to look into Spanish government bonds, you would not be able to spot the time of the resolution of Banco Popular. It was basically neither to be spotted there nor, perhaps with one exception, in any of the bank's bonds or bank equity. It was a very clear case. Sberbank was a bit a peculiar case because clearly the basic idea in this case was that if Sberbank fails, it will be for the Austrian parent to basically bear the losses and to resolve. Now, you never plan for a bank that fails due to a lack of trust coming from a war scenario and looming sanctions. So what we basically were faced was with a liquidity crisis, a classic bank run, which made it impossible for the parent to support the subsidiaries any further, so that we ended in trying to take the best decision you can take at this point. And I'm always saying the resolution plan was very helpful to have a starting point to know where you were. But then you needed to react to the crisis, and you needed to find the best solution at this point in time, and not to say I had another idea for a totally different situation.
And were
Well,
there any learnings from that case that you'd like to incorporate into policy going forward, or was it just so unusual that it'll never happen again anyway? So
No, I think the one learning of this, or one simple fact, is you do a resolution plan for a baseline scenario. You try to prepare, you try to understand the institution with your baseline resolution plan. And the most likely scenario we always take is large losses make the bank non-viable. We also think about liquidity runs, but I think everyone in the room would have said if the team that's responsible for the bank comes up with a scenario, and what in case of a war, you would have said, did you have a bad night? Can we please stick to realistic scenarios and a plan? So the plan is a baseline, but the plan is not something that gives you a straitjacket. So you always need to stay very agile to be able to address the problem you have at hand, and not to say have a solution for another problem.
yeah, got it. Okay, Peter, we've got a question for you from the audience, and it's a question I think that you're going to like and be able to answer easily. To Peter, is the cost of regulation affecting the bottom line for banks?
Is the cost of
Is
regulation?
the cost of regulation affecting banks' profits?
For sure, everything that costs affects profits, but it's always a question, what do I get for it? And when banks have to pay to funds to create a stability in a financial system, looking at the overall picture, it helps also banks, for sure. The question is only how much. If Elke asks us for 55 billion euros in her fund, this is what is politically agreed. This is something that makes sense. At the moment, it looks like at the end of the day, she will have 80 instead of 55, which is much more than the original political agreement. Then it starts to getting worth discussing about it.
Elke, have you gone after them for an extra 25 billion, and where's it going?
No, I've not gone after 25 billion on top just for the sake of the SRB. No, to be fair, and Peter knows it very well, the 55 were a projection by very reputable people at the point in 2012-13 to say this might be about 1% of covered deposit at the end of the period. They were always a bit, as a guidance, they were not a politically agreed, we stop at that number. The agreement then was 1% of covered deposit, and I've always said those that wrote the legislation gave our team a fairly interesting task. You have to build up in even steps to an unknown number. Most people that had basic math classes know that this is a bit an unsolvable equation. I think we've done very well in trying to adjust it stepwise. And with depositors increasing till now the situation might change in 2022, 23. We might be closer to 80 than to the originally estimated 55.
All right, thank you very much. Irene, I've got a question for you from the audience. A decade on and 7 years into operations, the SRB only has one woman on its board. Will Parliament accept an all-male board when the current chair, being female, steps down?
I think that the Parliament has been always very vocal about it, and the Commission knows it very well. And I think it's a collective effort that we have to make. And the issue is not, for how I see it, is not simply to have a woman at the top, which of course is always a good sign, a good signal to give. But the point is to have women involved in the process, because the problem is that for many years, when we received, the number of candidates for a top to be evaluated for a top position, there were no women included in the process. And so this is a battle that we as a parliament always fought, and we've been fighting also in recent years. And I think that we've seen improvements. Also, if you see the appointments that have been made in the past couple of years in various European economic authorities and institutions, ESMA, EIOPA. I think we achieved good results, but we started with the process.
Totally, and I totally appreciate that this is a journey, and you can only appoint people from the available pool. But very directly, if we get to 6 months' time, Elke steps down, will the Parliament say that there must be at least one woman on the board, or will you accept an all-male board?
I think that we need to receive a pool of names that are gender balanced, and then we will evaluate on the basis of competence, because
so
that's
even
what
if we end up with a board of all men, that's okay.
The selection is made on the basis of competence, as always has been the case. And I, as a woman, I would never desire a woman at the top because she's a woman. All the women we have appointed, they were appointed because of their competence, not because they were women. But we want to have the possibility of evaluate women in the process, and that's the demand that we ask the Commission or the other institutions when they have to send their names. We want to be able to evaluate both men and women and see who's best suited for that post. That's where we are inflexible.
I understand that, but there's also an optics element to it. Having a board which is entirely male clearly isn't going to look good. And there's also the element of balance, where people argue that if you have a mixed gender board, that's an advantage in itself. So Elke, if you were to hand over to an all-male board, would that disappoint you?
I think there are some questions to which I don't take a position. I would hope that we keep a balanced board, and that we keep the most balanced board by talent and by capabilities. And I would be probably disappointed if it's then an all-male board. But let's also be fair, and this is more to everyone outside. If women are not applying for positions, it's difficult to have women. So I would strongly encourage everyone for positions, please apply. It's worth the effort.
Okay, thank you. Sean, a factual question for you, which is a bit close to home for us, I think. What happens if a DGS backed by an EU state, if the EU state itself is on the brink of bankruptcy?
Let's hope it doesn't happen.
This would be a rather troubled situation. I mean, I think if that's the situation, then the problem is much wider than the GGS, okay?
So we're into bailouts again.
So we're into a much different scenario. But I mean, there is no expectation that we will be in that scenario. So let's be clear. But there were, of course, risks during the last crisis. This was one of the problems which was emerging, that when you're in a state which is in itself, the state itself is on the verge of bankruptcy, of course it cannot underwrite all the things it needs to underwrite. But you must remember, we are working in the whole crisis management field, we are working towards a situation where that won't arise, where the need for the state to step in behind the national DGS. And this is, I give you what I was going to say earlier, when you work on crisis management, if you want to be faithful to the underlying principles of the BRD, which is that you preserve financial stability, but you protect taxpayers to the highest, you do not want to have a situation where if the national DGS exhausts its funds, that the national government must step in. And that's where we're going to find that having EDIS around would be very useful, because EDIS could play that role of providing liquidity that the state would normally provide. So therefore, having EDIS in the frame will allow us to satisfy both principles, both kind of objectives of this BRD fully. Preserve financial stability, maximum protection for the taxpayer.
So I'm going to turn now to the crisis management framework. I think we've got about half an hour left on the panel. Beyond the EDIS, which you talked a lot about, Elke, what are the other potential sticking points, do you think, around the crisis management framework, or what needs to be ironed out?
Well, I think the first point is clearly, and the Commissioner mentioned it, and Andrea also, I think, mentioned it, that we have obviously an agreement that we need to ensure that a bank that's failing, a mid-sized bank, can exit the market. We are living in a market economy, so we're not living in a system where the failing ones get some safeguards around and then carry on. So the main part is to ensure that a failing bank can exit the market without causing financial stability concern. For this, you can broaden PIA, you can use the resolution powers, and as I said, then you need to think about what are the financing mechanisms behind. The second part is clearly something we've seen, and I hope for some movement there. We are living in a world where insolvency systems are national, and I've made the joke, I thought the Austrians should be similar to the German one. I assure you we speak the same language, but the systems are different. So we have 21 or even more systems, and I would hope that we see some narrowing down of unnecessary hurdles within the national systems there. I'm not expecting that we harmonize insolvency systems at all. I'm expecting that we harmonize the most mattering parts in this area. We need to address once more also the topic of a single banking market, which means where are we on liquidity waivers? I'm looking at Andrea. I think he's not happy with where we are. And the like could also be a topic, not sure whether it really fits into this framework. And those already would be good steps forward. But let's also be realistic to your previous question. I think we should never forget how much better the system is already equipped. Risk reduction got a bit out of our view now. We have achieved quite a lot, have made the system by far more resilient. So we are talking now, when we talk about the crisis readiness, about a backbone to the system, but not about something that has to jump into action tomorrow, hopefully.
Thank you. So, Peter, I'd like to bring you in here as well. In terms of the crisis management framework, what are the key sticking points for your constituents? And I guess possibly there's different ones, given that you span such a large range, but maybe give us two or three of them.
Yeah. So, first of all, we would like to see here an evolution and not a revolution. We hope that Elke sentence, the resolution, is not for the many, it's for the few, not for the many, is kept alive, and will also, in a modified framework, be the leading rule. And we would hope to see here more proportionality in all regulation that we have in. So this means looking at the size, the complexity of business models in all things, from the resolution planning, but this is something in general that we would ask for. If we could manage this, then I think we meet better the needs of all the actors on the financial markets.
Okay, thank you. Irene, I'd like to bring you in as well. What do you think are going to be the key sticking points around the crisis mechanisms?
Well, you mean in Parliament, the
Yes,
Parliament debate?
in Parliament,
because
yeah.
I still can't, tell much about because we haven't opened the debate yet, so we have to still see the proposal. So, but of course, this is a topic that we have been discussing over time. So what I can foresee as an issue, and one thing that I have to say, that is I want to make it clear. The fact that we have isolated crisis management and leaving the EDIS, which is supposed to be the most controversial, doesn't mean it will be easier, honestly. I don't think, I'm sorry, I am myself an optimistic person, but I need to be realistic as well. And the crisis management has its own challenges. And one is what Jean just mentioned, the fact that it's closely linked, for example, to EDIS as well. Because then it would be difficult to have that kind of intervention without addressing the issue of the funding and without addressing the issue of a common safe net. And so these, I think, it will be the biggest issue and the biggest challenge that may make it difficult to get an agreement. Not to mention the risk, I hope I'm wrong, that we end up undoing some of the progresses we've made, to the extent to which, if we go back to a more renationalized way of addressing the crisis, we narrow the scope of the SRB, and for me that would be something to avoid. But it's a risk, because if there is no exactly, with no possibility of having a European safe net, that's the risk, that when you are going to review the crisis manager, you end up renationalizing or pushing everything on the national DGSs. So I think this could be another issue. But it's early. I don't want to be too pessimistic. We will put all the effort in trying to make it work, but it is indeed a challenge. So
Sean, how optimistic are you about crisis management getting through fine?
Oh, I'm very optimistic. I'm even more paid to be optimistic than other people. But no, I am very optimistic. We're all experts around here, but this all boils down to pretty much what Elke said. We want to have a framework that allows banks of all sizes and all business models to be managed in a crisis in a way that reconciles these two fundamental objectives of the BRD. You preserve financial stability and you protect the taxpayer. That can be done, but as we've seen in the cases so far, it has created a lot of stresses in the system. It doesn't need to be as stressful as it has been. Now, it's an old story. We used to know how to handle banks that were too big to fail. Governments used to bail them out. And now we've moved to a system where, creditors bail in and governments no longer bail them out. So we know how to handle the big banks. And we know how to handle the very small banks. They go into judicial liquidation and they're taken out. The same old problem arises. What do you do with those banks in the middle? The ones that are too big to be managed through judicial legislation or judicial proceedings, but not big enough to fit into the framework as we have it now. So what we want to do is to extend that framework to capture those banks in a way that allows them to exit safely from the market, preserving stability and not costing the taxpayer. And that means we have to go back into the system and look at certain changes we would have to make around the use of resolution. So that relates to not just, we always speak about the public interest assessment, but also the early intervention part has to be discussed as well, because we have issues there. So I put those together. If we're going to extend resolution to these mid-sized banks which may not have internal funding and may not have bail-inable funding available, we have to think about what external funding available. So there, we have national DGSs. Are they most efficiently able to intervene? In some cases, yes. In some cases, they're able to intervene in many ways. In other countries, they can only pay out. The question arises, is this the most efficient way to organize DGS? So you must look at how you organize your DGS to optimize your funding possibilities. And then to do that, you're going to have to look at how DGS is treated in the insolvency framework. So
it's back to the insolvency.
Which brings us back. So as Irina said, nothing easy there, but at least the issues are clear. We know what the issues are. They're technical issues at one level. They have a lot of politics stringing out of them as well, but the issues are clear.
And when you think about the medium-sized banks, to what extent are those political issues complicated by the ownership of them in certain countries?
No, I don't think. That's really not the issue. The issue is really where you draw the line between the medium size and the small size. That's the more important issue. Where they're located, I think, is less important.
Or who owns them?
Or who owns them.
If they're owned by the German canton.
What really is important is how you draw that line and how you work out those banks. And that will be a decision ultimately probably for ELCA to do. We'll have to draw that line and say, well, this one I can take into resolution and this one I will send to national. But ELCA will need to feel secure that when she sends it to the national level, that the national level can handle it.
I think that's probably one of the topics we had to learn, that we need to really have a clear understanding of what the national DGSs then are capable and allowed to do, because otherwise you might end a bit in this situation, well, the national authority should take action and says atomistic liquidation will be a disaster. And at the same time, you don't have really an answer how to deal with a mid-sized bank. So I think there's a lot of work to just clarify and then to build the necessary funds, be it in-house or be it as part of a framework to deal with what we, I think, all call under alternative measures. So if you talk about purchase and assumption, well, if the DGS then says, but then I'm off the hook because I'm only there for payout, it doesn't fly.
Okay. We've got another audience question. Sean, this one's going to go to you because it's going back into the previous one. Speaking about crisis management, do you think precautionary recapitalisation worked well in the last decade, especially under its temporary aspect? And maybe explain the temporary aspect for me.
Well, the precautionary recapitalisation is essentially a temporary concept. It's given to you as a precaution, and then it's supposed to be given back when the temporary disturbance has passed. Has it worked well? Well, it has worked, that's for sure. I mean, we have used it, and it did prevent problems.
Who did we use it for?
We used it for Montepaschi.
Okay.
They haven't paid it back.
I was going to say, are we calling that a success?
But, as I always had this discussion with ELCA, we never define what temporary is. So, I mean, temporary comes to an end when it's right to come to an end. But I think it's another area where I think if we get the crisis management framework right, we get the early intervention part right, we get all of the other parts right, precautionary recapitalisation itself also worked better because it was one of the instruments we were having to use in these stressful situations where, as I said, the crisis framework wasn't optimized, and it's still not optimized. But I think if we can get it into a better shape, all those things around precautionary recapitalisation will become much easier to use and will be used, I think, for, let's say, more standard purposes.
Elke, are you a fan of precautionary recaps?
I would say within this entire framework, as I mentioned earlier, we need to look into the crisis management framework. We also need to look into the banking communication, which is DG Com's own rules around state aid, to align them. Here we have still work to do, and I would stay consistent to say, and we need to have aligned incentives so far. Neither the bail-in rules are the same, nor do we have a fully aligned logic there. So this needs to come. I would leave an instrument like precautionary recapitalization in, but with a clear understanding what temporary means. Temporary is not eternal, but is it 3 years? Is it 5 years?
So you would effectively have a maximum cap on it.
Yes,
A cap.
I would think I'm not even sure whether I would put a maximum cap on it in writing, but I would have a clear understanding what temporary means. It was designed like TARP for bank to restore confidence, not to be used, but to basically then thereafter being withdrawn. And I think there is still room to go, but I agree also with Sean, it has to be part of the overall framework.
Okay. On to a more general topic, and this is going to come to all of you at some point. Quite a lot, we're talking here about the test of time, and it has been a decade, give or take, since banking union was first envisaged. A lot has changed in the world since then. So how do you think about whether banking union is fit for the financial landscape now? And like, are we arguably fighting the old war, and actually we should be spending more time thinking about crypto or thinking about shadow banking rather than still dealing with this thing from 10 years ago? Sean, is there an opportunity cost in terms of how much time is being spent on banking union versus the new finance out there?
I don't think, I think today, Europe remains pretty heavily bank dependent, if I'm honest, despite my own best efforts to push capital markets union and to push the digital agenda. I don't think they are necessarily going to make the banking union somehow irrelevant in the short term or even the medium term. So I think the agenda we set ourselves in 2014 to not only have, to have an architecture which will allow us to have a properly supervised, adequately managed in crisis banking sector and an integrated banking sector is the same today as it was 10 years ago. Yes, there are changes. Yes, there are things on the horizon. We have digital, we have crypto, we have other things. Actually, digital and crypto are a bit different things for banks, to be honest. They present different challenges. But I think this does not in any way reduce the validity of the banking union argument at all.
But is there an argument for maybe updating it?
Not particularly. Not as we have laid it out. You always have to be aware that the world is changing, and we change bank regulation all the time. But the construction of banking union, the architecture we put in place and we want to put in place, I think remains valid today.
Elke, do you think banking union is still fighting the right problems?
I think banking union as a concept is spot on. I would not see this changing. Where you need to be mindful is that you keep an open eye, where you might see you have always focused on this and this problem. Well, a problem might be a different one. So keep an open eye on what if a bank is failing due to something that 15 years ago you wouldn't have considered a problem, like a cyber risk attack. But the basic concept to have within a very integrated market one banking supervisor, one resolution authority, and a safety net which is the same for all of us is there. What I find where we need to make progress, but we haven't missed the boat. We're not fighting an old war, is that capital market union needs to come in place, because still it's helping the banks also to have a strong European capital market. But no, I think overall banking union is as relevant today as it was when we invented it.
Peter, do you agree? It's as relevant today as it was when they invented it? Maybe you didn't think it was ever that relevant, but...
How relevant it would have been to be already in place, we saw in the crisis, and it will remain relevant for all times. The question is, how much do we have to work on it? And as I said before, evolution, not revolution. So to make things better, to sharpen things, to create perhaps more predictability or transparency in the one or the other thing. These are the things we have to solve and work on. And I think it's not a contradiction to work on both, to deal on the one hand with all these questions coming up with digital currencies, crypto, all these things on the one hand, and on the other hand, not to forget to adjust the regulation for the banking union always to the needs of the time.
Because, Irena, when you think about the overall priorities in the political landscape, the next crisis, we talked earlier about how a crisis can really gather a lot of momentum and focus. The next crisis looks more likely to be in the digital/crypto area than in the banking area. So is that going to mean that a lot of the focus gravitates towards MiCA rather than really the kind of political support that they need for banking union?
I think we need both. I mean, I don't think they are incompatible. We are working on both things. We are, now we are in the negotiations on MiCA. Christine Lagarde came to us in our monetary dialogue the other day, and she was already talking about MiCA too, because she said we need to do more. And
not a fan, Sean.
I'm just, putting it to you on your table, Sean, and so that's definitely a stream of work that we've started. Honestly, I think, of course, it's a big thing for us to be able to close the MiCA negotiations. We have a trilogue next week, and hopefully. So, but I think it's the beginning, of course. I don't think it will be ended there. I think we will need to monitor this. So when everything that entails the cybersecurity, we did the DORA, the digital operational resilience. We have this continuous, dialogue with the ECB on the digital euro. So, of course, this is something we have to monitor. We have to be ready, but that doesn't mean we can do without a strong and resilient and really truly European banking system. I don't think we are there yet. I don't think the two things are, substitute one for the other. And so I really think that we need to push, because having a strong and resilient banking system actually will help financial stability also in the face of emerging digital risks. If we have that kind of banking system that is more resilient, more profitable, more integrated, and also capable of innovating, because let's face it, some of the innovation that is coming up, like mushrooms, unregulated, is also because the banking system failed the innovation challenge and didn't see some opportunities that others saw. So I think it's our job to help the banking system to become more resilient, more profitable, more truly European.
Thank you. So, Sean, there's certainly a feedback loop there in terms of what happens, say, in the digital landscape and the banking landscape and the financial stability world. Do you see any potential for the crypto crisis to get so big that it actually triggers a crisis in the banks that would then give you the capital to kind of get banking union moving faster if it becomes a financial stability issue for banks?
I hope not. I don't think so. I mean,
because there is, there are some linkages there that...
No, there are linkages. I think we may have been, in a sense, lucky that this correction, and we're not sure it's a correction now, happens now, because we are begun to become a little bit more concerned about crypto and that space in two dimensions. One, it has been getting bigger, of course, and growing quite rapidly. Not yet at a sort of systemic level on its own, but still growing quite rapidly. The second area we worry about is, of course, interconnections between this new part of the financial system and what we call the traditional part of the financial system and the banks. Not so much so far. So I think if people are hoping for a crisis coming that route to build the banking union, I don't want it, and I don't think it's a risk at the moment. But I think, again, not a good idea to start looking around for useful risks to build the banking union.
Fair enough. Irena, we've got another question for you from the audience, the digital audience. The questioner says, the Eurogroup didn't agree on a work plan to complete banking union. Should the European Parliament now take up the mantle and attempt to agree a work plan?
I mean, we can try, but unless there is an agreement at the level of the of the member states, we still have the EDIS proposal in the drawer. It's there, and I don't know. Maybe we can try to resume it, and I have tried to talk to the rapporteurs from time to time and see. But if we don't see the political will, to really push it, I think the Parliament alone, we are co-legislators. There is this co that at the beginning that, but maybe you're right. Maybe we should try to push and force a little bit more and see if it works. But we have tried on many other accounts and then ended up, stranded on the beach. But we'll see. We'll see.
Sean, for you, I hadn't thought of this, but in order to complete banking union, do we need to prevent member states from being shareholders of banks like happens in Portugal, France, Belgium, Germany or Italy?
No.
Does anyone want to ban state ownership of banks for banking union to go ahead?
I don't see it really as really a relevant issue, frankly.
Okay, that's a quick answer for that one. I think we have 2 or 3 more. The digital audience is very active. Yes, definitely. I have tried many times. After this one question, we'll come to the physical audience where we have got hands. Thank you. This is for, I think, either Elka or Sean probably. What could be the destiny of a bank failing from a precautionary recapitalisation? Is PONV a new restructuring plan, a liquidation?
I think the legal framework there is pretty easy. If the bank fails its commitment within a precautionary recapitalization, this would turn it, from a Commission point of view, into illicit state aid, and this in turn makes the bank failing or likely to fail. Now, this is the legal text, so I think there's nothing to add. Okay. Unless Sean has a different interpretation.
I'm just also conscious of people's coffee break. We will take the questions from the audience in the room with questions. I did see a hand there from the lady at the front. If you could please, if you'd like to identify yourself and your question, that would be great.
Hi, can you hear me? Is that working?
Yeah, it seems great.
Okay, great. Hi, Catherine Carlson. I cover financial services for MLEX. My question is for Mr. Berrigan. Commissioner McGuinness in her speech earlier was talking about the upcoming legislative proposals on crisis management. I'm wondering if you can shed any light on what we might be able to expect from these.
Well, I think I've probably covered a lot of the ground that they will cover. As I said, I think what we want to try to do is to solve this problem we've had, and we thought we might have solved with this framework, that is how to handle those mid-sized banks that do not fit well with the resolution framework, but are also difficult to manage at national level using simple judicial proceedings. So we will have to, and I think if you read the Eurogroup statement, you'll see there are 4 or 5 areas where they suggest we should work. We agree that we should work in those areas. That's probably not a big surprise since we're sitting around the table of the Eurogroup. So we will work in the area of extending resolution. We will work in the area of funding. We will work in the area of organisation of DGS and least cost tests and where DGSs fit into the insolvency proceedings. But as Irena rightly pointed out, these are technical on one level, but they have political implications as well. So this will be an interesting discussion.
Thank you. And we have another question from the audience. The lady back here, I think, wanted to ask one.
Hi, it's Jodie. I'm part of the Capital Solutions Group at NatWest Markets. Elka, I think you mentioned before that there's one first step to mutualising, which is harmonising. What are your views on the possible implementation of full depositor preference across Europe? So like we have in Italy and Portugal and Greece. And do you see that happening anytime soon?
I'm not sure that I got the question fully here. Might be my ears. Yeah. Depositor preference, I think, is a topic which is part of what will be within your proposal, because if you talk about funding, well, then you talk about a DGS to be part of the funding. Now, you need to have some, I would call it even a cap, called least cost test. And if you look into historic experience in depositor systems being exposed, then it was mostly a pre-funding of covered depositors, because out of the proceeds, in the end, the DGS was repaid from the proceeds of an insolvency. So in a nutshell, in a world of where you forget about interest, the least cost is zero. This is not very helpful if you want to fund something.
And maybe just a very quick follow-up question. In a Europe where full depositor preference were to exist, would you see minimum MREL subordination requirements being reduced potentially?
The very simple answer is that the fabulous 8% to access the fund are part of an intergovernmental agreement. So this needs all member states to agree to something else. So not for us. I would say, in my words, always, all banks need to have a sound layer of capital/MREL. And then you might talk about different solutions. I'm not a firm believer that I say I need to be very firm on the big boys. I have an insolvency for the very small, and the ones in between need to have somehow a free lunch. So they also need MREL, they also need to be resolvable, in my words. But let's wait for the proposal. But clearly with the current super priority of DGSs, you will not get much funding contribution from a DGS. So you need to think about what is the right point. I would say depositor preference is a good starting point.
Okay, thank you
But
very
that's
much,
my
Elke.
personal view.
I hope that has answered the question. Unfortunately, we are just about out of time, and I'm conscious of people's need for caffeine and also of everyone telling me to wrap up. So thank you so much to my panel. You've been excellent. That was a very fast hour and 15 minutes. So thank you so much for everyone. Thanks very much to our virtual audience who was great with all of your questions, and to those of you in the room as well. Thank you.
Indeed, thank you very much to Laura and all of our panelists, and also to those of you online for providing such great questions, led to a great discussion. We'll now take a short break. We'll come back together at 16:35 sharp. So please, we'll see you then at 16:35. For those of you in the room, we'd like to invite you for a coffee outside. Thank you. Hello and welcome back, everyone. The theme of this event necessarily takes a bit of a look back at what the banking union has achieved and where it might have fallen short. Our next panel, however, jumps ahead to the future to take a look at banking in 20 years' time, what that might look like and what that might mean for all of us. Let me hand over now to our moderator, journalist Jennifer Baker, who will introduce our panel.
Thank you very much indeed. It is a delight to be here. As you said, for this panel, we are looking to the future, which means we are looking ahead at Banking 2040. So there are no wrong answers, which is wonderful for my panelists, as experienced as they are. So I'm very pleased to introduce next to me, Patricia Boydens, who's the Innovation Consultant and Vice President at FinTech Belgium and the FinTech Ladies Ambassador here in Brussels. David Martin is a Consulting Strategy and Regulation Partner at Deloitte in Spain. And finally, we have Marilyn Picaro, who is Director of Innovation, Conduct and Consumers Department at the EBA. Thank you all very much for being with us. Now, we want this panel to be quite lively. You're going to look into your crystal balls and tell us what you see for the future and what might be coming down the road, and hopefully a little bit of what you would like to see coming down the road. And we want the audience, of course, to ask questions using the app, using their online tools, and here in the room. But we're going to kick this off by I'm going to ask you all for your elevator pitch, your 3-minute, this is what I think is going to happen and why. Patricia, I'm going to start with you.
Yeah, thanks a lot, Jennifer. What my elevator pitch, 3 minutes, then I would say the absolutely trend I see is open finance. And open finance meaning open data and, of course, data control, because we had now the Data Act in February this year. And of course, the aim is to make more data available, because data availability is uttermost important for the financial services industry, because all these new technologies like AI, and you have machine learning and all the connected devices. So with this data, they can generate, of course, new financial products and services, but it's only possible when data is, of course, accessible. So open finance, I know, is also within the EU digital finance strategy, so I know it's one of the pillars, so that's what I'm explicitly referring to this here and now. Because, you know, we had already PSD 2, so there is already the reinforced data portability, but that only reflects, excuse me, the current accounts, transactional data. But what I'm referring to is also make this data available of all financial products and services. So not only the current accounts, but of course add also savings accounts, investment accounts. But financial services doesn't stop with banking, it also goes beyond. So I'm also aiming towards pension schemes, towards insurance policies. So with this open finance, people can take, of course, control over their own financial situation and have, of course, this holistic view on their financial situation. Because with open data and with all those new technologies, of course, technology like AI, you can run the algorithm in order to see if your investment portfolio is still in balance with your own risk profile, for instance, or maybe you are over-insured or maybe worse, under-insured. So open data, new technologies, and that's the way to go forward. So I would say PSD2, then comes PSD3. No, not even open banking 1. No, we need open finance 1. That's what I mean. And with the data, with the new technologies, then we can build a whole new and better, of course, financial product and services, more tailor-made, that be more transparent, cheaper, of course, and of course widely accessible and available, because financial inclusion education by giving those insights in those new dashboard or other products that will be possible. So that's a bit my elevator pitch. Thanks.
Thank you, Patricia. I'm sure we will talk about some of those issues as well as we go through our discussion. David, what's your vision of the future?
Hello, I want to thank the SRB and the ECB first for inviting Deloitte to the conference. I think it's very, it's an honor to be in this first joint conference that marks the 10th anniversary of the Banking Union. So I'm grateful to be here. We were discussing in the previous panel the 10 first years of the Banking Union, and then we're looking at the next 20 years. I think banks are prone to change. They've been here with us for centuries. I think not many companies can say that. So one should assume that they will be changing with circumstances, society, technology, data, and everything that comes, and that's what we're going to talk about. I think if we look at the last 10 years, and a lot has changed. We have bigger banks, we have less banks, we have, I was saying before, an architecture, an ecosystem we didn't have before. We didn't have the SRB, we didn't have a resolution authority or a joint supervision. So if we look at project what the industry will be in 20 years, who knows, really? It's very difficult. I think we can kind of infer from the challenges that banks are facing now what could be the future. And I think the banks are facing a number of important challenges, like becoming the center of the relationship with the customers. I think they're as important as they are. They're not at the center as other competitors are at the moment. So keeping the role is essential. Data will play a very important part in that. Achieving sustainability objectives. I mean, they've been by the regulator. They've been put in a position where they have to contribute to the ESG policies of the European Union, and that they're a very important agent in that change. Emerging technologies. We'll talk about that a lot in this panel. I think that's banks have traditionally invested a lot in technologies, but the speed of change is becoming incredible at a time where there've been low negative interest rates and low margins, small profitability. So that kind of makes it more difficult to cope with the big boys in technology. Talent management. I think when I was younger, working for a bank was a very good option. I don't think nowadays is what the kids have in mind when they finish school or university. There are other startups and there are other places where they want to go. So banks have a challenge in keeping talent. Increased competition for new players. Not so much existing players or peers, but new players, like particularly in payments. We see with open finance, we're going to see animals we haven't seen before. Of course, big tech and other things. And of course, new business models that have emerged as a result of regulation, but not only. And in terms of the trends, I think I would agree, obviously. Data, what we call it, there will be two main drivers. The data economy, so everything about data, who controls the data. I think banks are in a very good position. They have the trust, they have a lot of transactional information from clients, so it's not that they're not at the data center, but they need to be more so if they want to be at the center of the relationship with the client. And then, of course, the digital economy. I think digital economy is very important in terms of we'll talk about blockchain, we talk about crypto, we talk about internet, the new internet, artificial intelligence. So those two trends will pave the way for the next 20 years.
Well, thank you. And Marilyn, your elevator pitch, we're calling it, but your opening thoughts on what you see in your crystal ball.
Yes, thank you. Thank you for giving the word, and I'm honored to be here and share my thoughts. So I would list 4 or 5 key things that I have in mind for the next 20 years perspective. First of all, it is likely that we are reconsidering what is a customer-centric service model or customer-centric approach to the financial services overall. And what I mean by that is a customer most likely in the future is not the one who is chasing the bank or chasing any service provider. It should be seamless for him or her. All the needs the customer has are kind of predicted and managed by the financial institutions without direct orders from the customer. And I will elaborate later what this potentially could mean and what are the considerations here. Secondly, my thinking is around financial services for everyone. Unfortunately, I still see that we are largely fragmented based on some years old data by the World Bank still indicated that across the European Union we still have 30 million adult citizens without access to the regulated banking services. Most recent numbers most probably are on the way. So I'm just wondering, what those 30 million adults then are doing, and they are actually excluded then from other opportunities they would have either in the job market or social benefits, and we are actually increasing the poverty, inequality, etc. So basically banking for everyone, despite your geographical location, gender, income level, whether you are in the big city or rural area. Going forward here, thirdly, now if looking more to the financial institutions side, most processes are automated or automatic. So obviously servicing all the customers in the world or all the customers in the European Union, financial institutions must think about their unit cost, and there is hardly room for the manual works. And that also applies now to the other side, controls, monitoring, and also policy development and the supervisory activities, as it's often I use the term invisible controls or invisible compliance. How we ensure that we actually meet all the requirements that we are not even able to catch up with, but in a way that it doesn't require manual work. So that's one topic to discuss a bit later. And lastly, I would touch obviously the awareness. So those young citizens who are today in the kindergarten are the ones who are making difference in 2040. So what we are teaching them now, and whether we are teaching the right things for them for the future. Yes, I would stop here.
Well, I wasn't expecting any easy answers, but I think we've got a lot to dig into there. I think, Patricia, let's start with, it sounded to me that a lot of you were thinking in terms of evolution rather than some sort of crisis-driven revolution. But I think we also heard ideas of innovation. And that sort of innovation needs to be driven by something. And I'm curious, what do you see as the main challenges or the main drivers to sort of innovation in the fintech sector? And is there anything that regulators or policymakers could be doing to foster an innovation-friendly environment that also still protects consumers?
Yeah, I think the word has already fallen in the other panel during the last debate. And of course, one of the biggest strengths of innovation that we see right now has everything to do with decentralized finance and Web 3.0. So, of course, my let's say my speech was all about open data. Of course, those technologies, the distributed ledger technology needs data. Otherwise, it can't work. And also David already briefly touched it upon the Web 3.0. It's all about digital economy, but also the ownership economy. So it will be, of course, Rome wasn't built in a day, and evolution also comes in waves, but in 20 years' time, for sure, decentralized finance will change the way how we look at money now. It will be a completely other setting, decentralized, meaning that now financial institutions, it's a board or the ExCo that takes a strategic decision. Decentralized finance, you will have maybe one DAO taken as a community. They will take the decision based on their rules and their procedures, and there will be no one individual who can break the blockchain. That's not what this technology is built. Yes. So I think that will be the game changer, but of course regulation also must follow. We have MiCA, luckily, because I know a lot of fintechs, fintechs also involved in blockchain projects, in digital assets, in cryptocurrencies. They are demanding this regulation because it needs to be transparent. There needs to be customer protection. Of course, they are really asking for this kind of legislations, and it will be the same for other decentralized finance products and services, and we need regulation because also we need standardization. As you know, now we have more than, 18,000 different kind of cryptocurrencies, and of course not all of them are going to survive. So, but we need the regulatory framework also for the standardization. It was only recent in the press that Meta has joined a kind of a metaverse forum with several other important players like Microsoft, like Alibaba, and now they are trying to build one centralized standard for standardizing the metaverse. So means for me regulation, standardization, and that's the way forward with this new Web 3.0. Yeah.
Well, I'm going to build on what you've just said because I want to bring Marilyn in from the regulatory side and ask what sort of regulatory rules, what sort of supervision do we need to see with this sort of innovation that we're talking about? And in fact, I see here a question in from our audience already asking about whether there's a concern between the lag between the old people, as they put it, making legislation, and the young people developing banking and finance technology. And, some old people make innovative things as well. So how can the EU regulate if they're not even aware of the tech? It's a challenge, Marilyn, I presume.
Yes, I have an honorable role to be a director for the innovation department at EBA. So we are the ones who should understand and write guidelines covering the innovation. I don't consider myself too old yet. And I can confirm that most of my team members, I haven't asked their age, but it seems to be not old yet and they're not retiring anytime soon. So rather young, enthusiastic team. But there are a few obvious challenges, obviously. So that regulation is always about the past. I mean, majority is about the past. So this is at least how the practice largely is, because it's very hard to regulate something that potentially comes in the future. I'm not saying that it's impossible. So this is one idea for me to figure it out, how we could regulate the future that is not here yet. But I guess it's the first step here is not to be late. It would be already an accomplishment if me with the team and other colleagues would come out timely with short guidance, some explanations, even training events, and therefore having this dialogue, open dialogue with the market participants and building the way to the future together. I do have a private sector background in that sense that largely, I think I know what I'm doing, also from the banking perspective. But the truth is that obviously the world is changing fast. So, and there is not a single person who could be always up to date, the most recent developments. And that's the beauty of the game. So we need to do it together. And having this dialogue and then frequent interaction, not to be afraid of each other, because eventually we are actually on the same side. So,
David, I wanted to ask you about the impact of these imaginary at this point new technologies that might have on your business, and also the challenges around the protection of data. And again, this is the audience is beating me to it every time. There's another question here asking, why should I share such sensitive data with an unknown and maybe not properly supervised company? There is a need for trust, isn't there?
Mm-hmm, absolutely. I think I mentioned the two drivers that I see is data and the digital economy, and data is certainly at the core of the present and the future, I think, right? We have an ambitious agenda in Europe in terms of opening data, which wasn't the case a few years ago, and that is in process. We have, I would say, the Digital Market Act, the DA, and the Open Finance. We had before the PSD2, now PSD3. So we have a number of pieces of legislation that are in the business of opening the data across industries, and not only in the financial industry, but also across industry, and that's going to generate a new economy. That's what we call it, the data economy. That has benefits, brings opportunities, but also has challenges for the industry, right? In terms of the opportunities, the additional data that the banking industry doesn't have, and hopefully will get through this new framework, will allow them to be more efficient in terms of operation, will allow them to design better products for the clients, because they will know their clients better than they do already. And it would allow them to assess risk in a better way with more information, not just the information that they have on their record. So it has, a potential enormous benefits for the players in the banking industry, but also it comes with challenges. The challenges are that, as it happened with, I think in the last 10 years, we've seen a lot of concentration in the traditional banks, but we've seen a lot of new things happening in the payment area, and I think PSD2 is partially responsible for that. It has brought new animals in the room that were not there. I think Open Finance will bring even more animals in the room. We cannot think of new business models. So I think it's a great opportunity for banks, but it's a great opportunity for new players that have not been born yet and will be born as a result of Open Finance. So I think open data will bring more competition for banks. I would say banks are in a good position. They have a lot of data already, maybe not so much as the big tech, for instance, although those business that have placed themselves at the center of the data, they generate data. So, but maybe the banks have to change. I think that they're not too bad positioned to do that. And lastly, I think the challenges are in managing that data. So there is the issue of intellectual property and the protection of businesses. So there should be some protection there it's not a free lunch where information will flow anywhere. So that information needs to be duly protected. And also GDPR and also personal data as well has to be. So there's a balance between opening up the economy, creating a new economy, which is going to benefit everyone, public authorities, banks, other companies, customers, and at the same time protecting data that is sensitive and trust. And trust is the definition of a bank. Yeah. So I think they're, if they play the cards right, I think they have very good credentials to be at the center of this new economy.
Marilyn.
I want to create an image for the future. So, as a citizen, if we could have a digital wallet where all our data is literally placed, and obviously I'm owner of my own data, and I can pick what type of data with whom I want to share, and I also may choose to withdraw that. And the question of trust is, it's really up to me to decide whether I trust the small player, some innovative startup, or I'm more traditional. I want to have a company with old traditions, with long legacy, partnering with me. But the question is, what I get as a return, because I give my data, whether I experience then super user-friendly environment where all the transactions and all my financial affairs would be managed behalf of me. Maybe I would be interested. But I may be also more conservative side and say that I don't actually want to share my data. I want to do my own transactions. I want to make my own decisions. I don't need any predictive models, algorithms, and etc. So I guess the picture for the future is really for the citizen to decide where, how, and when we are sharing our data. And based on that, obviously, different things could be built on. Thank you.
Well, Patricia, to build as well on what Marilyn is saying, a lot of these sort of services that we're talking about sound like they're going in the direction of democratizing finance and providing access to those 30 million or so people, as you said, maybe are not connected. They all build on the backs of other things, such as access to online services, access to the internet, and educative knowledge to understand how to use it. How do we build all of that into our societies with the idea of keeping the trust there?
I think, of course, trust is extremely important. And like Marilyn said, as a consumer, you must, of course, give your consent, and you have full control on to whom you will give that data. Of course, when then I look at tomorrow, we will have this, of course, hopefully widely spread new technology that it's called blockchain. And it is also this distributed ledger because it's controlled by a community and you can't break, you can't change anything. That will also provide those trust. I never say technology always needs to serve a purpose or the business problem or a customer's issue or whatever. You mustn't do blockchain for, hey, I'm a bank and I'm doing a blockchain project. That's not the aim, not to have a sustainable future. But technologies like blockchain can also help to build that trust and build it within society and have a decentralized financial system. And I'm also very curious how that will relate then to our hopefully very strong European banking union.
Well, I see here an audience question that in fact Marilyn answered, and I've only just noticed it. If data is the new gold, what will you pay me as a consumer?
Yeah.
I think
Yeah.
perhaps it's in terms like, ease of use, choice and flexibility, I think is probably the answers that you were summarising there. Another question that we've got coming in that's getting a lot of thumbs up is, could you talk about the compatibility of digitalisation with ESG developments? Patricia, perhaps you could touch on that.
Yes, that's a very, very important topic and issue, of course. We all read it in the newspaper that, of course, the Bitcoin is kind of the worst electronic crypto money that there is. Absolutely, that's true. It's consuming too much energy. Mining, Bitcoin miners are also in, let's say, some exotic locations where there is no real sustainable green economy that is already present. They even reopen, I've read, old carbon electricity, I think, providers. So that's not a good thing. But hey, Bitcoin already exists for several years. In this, like I said, innovation, it comes in waves and it evolves all the time. So now we also have other blockchain technology like Ether with Ethereum, and you have the famous proof of work, and the proof of work to add up on the blockchain. That's what demands so much electricity and computing power, of course. And now we evolve also to the proof of stake, what's less electricity consuming. So, of course, we are evolving, and I also think that if I may speak for the fintech community and the startup community, I think all those people are taking ESG very, very seriously. And also, I know even also fintechs who are even also specialized in ESG reporting, in making all the requirements also more clearly transparent, also for an investor, if you want to invest upon it. So yes, there is a lot of criticism and a lot of things can be improved, but we are aware. I think the community is fully aware of ESG, and I think it's a bit now with the real economy, there is a target and everybody is moving and trying to reach the target.
Well, of course, it's not just crypto mining. It's all this data that we're talking about has to be stored and processed somewhere, which is energy intensive. But on the flip side, you may find that actually being able to offer a more sustainable product is a selling point to the next generation who are concerned. Let's look at one of the other issues that cryptocurrencies have. They're sometimes seen with the undertones of criminality, David. And, you know, there's sometimes reputational issues there. Let's talk about bad actors in general and the problems that we may see in sort of weeding those out. What do you see as being the future in 2040? What will that look like?
I think I was thinking that the crypto or blockchain started about the same time as the banking union, but with quite a different career where we are today. It's not a very good moment to talk about crypto right now. I think my experience is that obviously it's been a story of success, and a lot of the actors in the banking community are looking with attention because, well, it looks very appealing. The clients are asking to get some part of the action as well, so they feel the pressure. But I think they're also very concerned that they're in a different position than those guys that are, at the helm of the crypto industry. So very, very. I think that the whole industry is expecting the first regulation in Europe, MiCA. I don't know if it's going to be MiCA 2. We just, we'll be happy if we have MiCA 1 for the time being. And I think that's, we'll see what happens with it. It's very early on in terms of where the technology is. So I think the technology has to evolve in the same way that internet has taken 20 years to where we are today. So it's difficult to predict whether this technology with the energy consumption and stuff is going to stay here forever. It has very good attributes. The very nature of crypto is a challenge for banks. Decentralized, so the role of a bank is to centralize between two sides, and this is decentralized, could be a challenge. But I think when people think about crypto, they just think about blockchain, they think about crypto, but I think there are other uses that are super interesting for the industry, like in areas like trade finance or smart contracts or complex transaction where there is mistrust between the parties. I think it will add. It will make a lot of sense to use that technology and for the industry to embrace it in certain areas. We'll see what happens with profits in those areas. But I see crypto as blockchain as an emerging technology together with the new version of internet 3.0 and artificial intelligence and other technologies. So I'm sure banks will embrace it, and I hope that after we have a proper regulation, they will enter into that digital economy, and with them the clients, and in a safe environment.
Yes, Helen.
Yeah, so I may compliment a bit, being myself close to 20 years chasing criminals in different roles. So, and I would just point out it's not about the particular mean how funds are transferred. Really, being a young professional, we saw huge amount of falsified banknotes. Later, just paper documents forged. And obviously this criminal kind of life and criminal way of living and acting, this is also developing among other things. So I would say that it's not directly related to the crypto or non-crypto. So this is just another way of transacting. There could be analog to the crypto or even the fourth way of transacting in the future. And whatever is the mean, we always should think about the risks and the basic principles we need to introduce. So, and that's the challenge with innovation, that what is this one page, maybe short overview of key principles we all should be aware of and follow, even if we don't really know what is this innovation or new product solution is about. And that's the regulatory challenge, obviously. So that's how to be proactive enough, relevant enough, timely enough for the market participants. So using the professional judgment, sometimes gut feeling, how things could go wrong, etc. So I'm happy, obviously, to spend hours on criminal minds and the investigations, but most probably this is not the topic for the Banking 2040.
Well, I did want to ask you on that. I mean, you mentioned gut feeling. AI doesn't have any guts, but is there potential for using some of these machine learning or AI or predictive algorithms to combat money laundering or fraud?
Mm-hmm. I may obviously take the topic that, yes, artificial intelligence, and obviously it's one of the kind of elements, machine learning, which is more understandable way or understandable way of applying technology. In a way, it has gut feeling because it's a supervised application of artificial intelligence, which is kind of rule-based, and it's learning based on historical patterns and information that is given. But unsupervised artificial intelligence kind of learns itself. You know, you don't really know how and when and based on what. And in that sense, that particularly in the money laundering, terrorist financing, bribery, corruption, fraud investigation area, any technology that would support analyzing a huge amount of data and suggesting maybe red flags, items to follow up is very helpful. And I do know that there is already practices out there which are supporting investigation compliance teams to do their tasks.
Well, David, you've worked on resolution. The same sort of question to you. Do you see an area where new technologies or new services might actually be able to help in the area of resolution?
Certainly in what is called the management information system. So kind of like I think like supervision or resolution without information are are just not possible. You will be doing your job based on imperfect or past information. Mm-hmm. So I think the fact that the new technology will allow you to have real-time access to the whatever you're supervising should make the job easier. So I think, yes, of course. I think banking resolution or supervision should evolve with the industry that they supervise. So if the industry is moving in that direction, they should also move in that direction. Otherwise, there will be a disconnection between both.
At this point, I want to see if we've got any questions in the room. Just If you can raise your hand if there's a question you will want to ask. Yes? Any others so I get a sense? Okay, 2. So we'll start over here in the centre, please.
Thank you. It would be rather a question to Patricia. One remark and one question. You mentioned we will have a lot of data. Maybe it's my professional damage, but a lot of data is not necessarily good. I mean, the data reliable, the quality of the data, it's something different than just a lot of data, right? And that's why my question, you mentioned when we have a lot of data, speaking about the blockchain, and the data is there and not changeable. When we think about the bail-in, for example, so you do have to do some changes to the data. And here's my question. What chances and risks do you see coming from the open finance and blockchain, for example? Because we do have to foresee all the risks and try to mitigate them. Thank you.
Yeah, of course, that's a good one because, yeah, of course, I'm also not a fortune teller, but like I said, we need the data to have this innovation going, and also we need the regulation because we need the standardization. Of course, in my perception, data standardization is also enhancing data quality, make it exchangeable between all parties, and of course, keep the data secure. Here in Europe, we have, of course, the GDPR data, the privacy, the personal data. That's a very, very important one. Of course, if we look at the US, you all know the big tech, the discussions that there already have been. Yeah, but I think it's important for the protection. It needs to remain in confident hands. And there comes the trust. Again, I think the blockchain technology will for sure enhance the trust. Indeed, there is a smallish issue when it becomes on privacy because GDPR says, hey, I have the right to be forgotten. Yeah, I just said, the blockchain never will forget. Once it's stored in the blockchain, you can't simply erase it. But I think that's just a small issue, and for sure we will have a workaround or work this out or make that it will work. But we need to protect also the EU, because if you look, it was also said that the EU is looking maybe for a digital stablecoin. It was also in the press recently that Circle now is launching a euro-backed stablecoin in the States, where, of course, our legislation don't apply, and they are keeping euro-backed reserves in premises, of course, in the United States with their financial institutions. The blockchain, the internet, there are no boundaries. So therefore, we must also protect here to have a strong digital economy, but a European also economy, because we know to whom we are competing. We are competing with states. We are, of course, competing with Asia. And as the internet and certainly Web 3.0 has no boundaries, yeah, we must secure our own financial stability, not only, of course, for the banks, but also for the future, for decentralized finance, for the ledgers.
Thank you for the question. I would love to talk about GDPR for days, but we will take our second question over here, please.
Thanks a lot. No, it was a lot in line with the previous question on indeed data quality and data sources, and how far are we from really having good data, because we still see a lot of concerns in terms of data quality. Also, we see standardization is still not there, so will taxonomies help? What do you see happening there? Because when we try to pull that together, we need to make sure that we are talking about the same things. And how do you see this evolving? And how far are we? So is it something for the next 2, 5 years, 10 years, or is it only for 2040 as you are talking about 2040 banking? Thank you.
Patricia, I think that's probably directed at you again. You can give a short answer. I know you don't know what's going to happen in 2040.
No. I don't know, but I do know that we need this legal framework because that will help with the standardization. If there isn't any legal framework, like we see Meta and Microsoft already teaming up to create their own standardization. That, of course, also will help. But we need to standardize. Also, we have that many cryptocurrencies. For sure, there will be currencies that will be completely obsolete, along with some maybe let's say some digital economies. But there will be the next wave, and there will be then a bigger community with better data, with where there is, for instance, this interoperability, so that you can go from one metaverse to another. But maybe to give you already a clue on the speed of innovation, recently Gartner stated that in 2025, we will spend each 1 hour in a metaverse universe, a Web 3.0. So that's very near future. So imagine what in 20 years the financial landscape will look like.
Well, I've just a couple of questions online that are very linked, asking, is there enough interaction between developers and regulators in this dialogue? As someone else has pointed out, EBA, ECB, SRB, DG FISMA, national central banks, national finance departments, who do new technologists and developers interact with? What advice do you have for them, David?
On how to interact?
Yeah, and who to interact with.
I think that when we see in my organization, we've seen the profiles of people working there changing very quickly. I mean, we have more engineers, data scientists, and people like that are specialists in the areas that we're talking. If we think that the future is in the data economy or the digital economy, you certainly need more of those people rather than lawyers or economists. And as I say before, possibly supervisors should be doing the same thing and kind of like enrich their human capital with people that are able to understand that language and are kind of like not too distant from what is happening, right? Otherwise, it could happen like with the crypto, that there's a big market happening and then the regulation hasn't arrived yet. So I think we should try to, ideally, by engaging in a dialogue, limit the time between what's going on in the market and the regulation and supervision that comes after.
Well, I think we're almost at the end of time, but since we're looking at the future and looking into crystal balls and dealing in magic, if I have my magic wand to wave and grant each of you a wish for whatever you want in the banking regulation in the EU by 2040, what would it be, Patricia?
Like I said, it must be open finance, and then if we have that, then technology can do its job, whether it's AI or machine learning or blockchain or whatever. Of course, let's say new business model, new economies that will help, and maybe. Just I want to touch one point because I do have also comments from the fintech community with supervisors. Yep. I think it's very important that the learning, training, and of course understanding and building trust. It all relates also to the theme maybe also of the day. Too much I hear it that it's purely a one-way conversation. And you need to be compliant, you need to comply. But there are also other possibilities, like, for instance, maybe the UK is a good example. There, you also have the regulatory sandboxes, which are not here present in Belgium. And I hear it's more like a two-way conversation, trying to understand each other. And they also try to think along, of course, within the regulatory framework, but you need to understand each other. And I think it will also be not a bad idea, maybe also to engage some more technical, skilled people who know the technology and what to do with it. Because for most of the people, it's like a black box. It's not transparent. But that's not what the fintech community wants. We want also to be. Let's open up. Yeah, okay.
Okay, my magic wand got lost. David,
Sorry.
what would you like as your wish?
I think if looking into the future, I think maybe I was looking banking union. I take it on. Maybe in the future it will be financial services union, because the way we see it is it looks already a bit old. I mean, maybe when it was we have insurance, we have asset management, we have banking, but I think things have changed a lot. We have new players, we have smaller players, we have payments. I think, as I said before, there's a lot of things happening in the payment space, and we will have more of those, especially going forward. So I think banks had a dominant position in the past. I think it was a decision made here in Brussels that it shouldn't be like that in the future. And maybe we can have a more comprehensive view of regulation and supervision, with the bodies talking to each other more. There are so many people doing things for the industry that is difficult to cope. I have a unified, comprehensive view that is positive for the industry, that is positive for the customers. That would be my. I know it's difficult, but that would be my wish.
And Marilyn.
Yes, so the question for me, obviously, is not what I would expect from the regulation, but how I plan to execute, or how we write guidelines in the future. And here I would, I do have a dream, and then one of those dreams is that if there is any entrepreneurs listening or people with innovative ideas, so it's obviously very welcome that you implement your idea, you understand that there is a market, there is scale, but then it would be very, very helpful if you have, let's say, a one-page description what type of guidance or regulatory challenges you are facing with your innovative idea, and also that you would come and present your challenges. So we would actually understand, and we will have a dialogue, as we are connected with all the stakeholders. So for us, it's not a challenge to sit on the same table with the ECB or SRB or national competent authorities. We're all there. But what we are time to time missing is really understanding what is the developments in the market side and what type of challenge you're facing. So where you need this guidance. And glad to think along.
Well, thank you all very much. I actually don't have a magic wand, so I won't be granting your wishes. And we don't know. 2040 is still quite a long time away. And I like to remind everyone when I finish a panel, when we're looking to the future, when we're talking about innovation, that we just don't know. Edison didn't invent the light bulb by trying to make a more effective candle. So anything could happen. All bets are off. But thank you very much for your attention, for your questions, and a big round of applause to our panellists. Thank you.
Thank you so much, Jennifer, and the whole panel for really interesting discussion. It can be slightly frightening at times, but I think a positive outlook overall. Ladies and gentlemen, unfortunately, this brings the first day of our joint event to a close. Thank you again to all of our moderators and speakers today, and in particular to the audience both in the room and online for your fantastic questions. We start again tomorrow morning at 9:30 with a keynote speech from KBC CEO Johan Thijs and a panel discussion on operational resilience in European banks. You really don't want to miss either of those, so please tune in tomorrow. But for now, goodbye from all of us here in Brussels. Thank you.